This is TreppWire Week in Review for the week ending December 8th, 2023. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. The Treasury rally, which began in late October, provided more good news for CRE borrowers. With the 10-year yield now 90 basis points below its peak and credit spreads narrowing, optimism has been on the uptick. This week's gains were driven by last week's benign core personal consumption expenditure reading, a lower than expected job openings number, and a cooler than expected ADP jobs report. But we saw some refinancings and new office leases too. So was it a better than average week for CRE?
It certainly feels that way. It feels like optimism is growing. As we've noted several times in the last few weeks, we are a long way from popping corks or giving attaboys or high fives. It does feel like we're going into the end of the year on an upswing. You nailed it when you said Treasury yields are now 90 basis points below where they were. We touched 5% several weeks ago. As of this afternoon, we were at 4.10%. When you fold that into the fact that risk spreads have been compressing as well, the average borrower right now for CMBS that is looking at a 10-year fixed rate loan is probably 100 basis points tighter than they were 6 weeks ago. Does that change everything? Certainly not. What it makes is borrowers that were cuspy, guys that were on the margin, gals that were on the margin in refinancing between a cash in and a cash out are probably now modestly cash out, right? The things that were on the margin have gotten better. The 10% of loans that borrowers were thinking, should I give up the ghost here or should I fight for? That 10% now might be worth fighting for. So it's not a situation where everything has reverted, where we are out of the woods, where liquidity is now unconstrained, where lending is going out the door hand over fist, where we expect distress to start going down, not up further. None of that is true, but we are in a better place than where we were 90 days ago. Rates are lower, risk premiums are tighter. We are seeing some transaction improvement, and by that I mean more of it. More deals are getting done. Something we'll talk about later is that we saw some big leases get done over the last few days, and all of that allows us to go into the holidays feeling just a little bit better than we did in September.
I would agree with you, Manus. I did have a question I wanted to get your thoughts on. I saw this posted this week where there were some people saying that as the 10-year approached 5%, it actually was forcing some of those sellers that were on the fence with unrealistic aspirations of sales price or whatever, like the fear of increased pressure on them was helping them bridge that gap between the bid-ask spread and bring prices down to a more realistic value. But now that we've seen that 10-year retreat, to your point, there's a little more optimism in the air. We're starting to see some new originations. You know, there might be some fear that this kind of like late year-end rally maybe prolongs some of that when we were maybe on the cusp of getting some of those sellers to be a little more realistic with the current market predicament.
Well, that's a very interesting take on the matter, and certainly one that I hadn't thought of, but I think you're onto something there. And the reason I say that is going through the sales that were announced today in the press and in press releases and so forth, it seemed like there was a sharp uptick in sales that were at prices modestly below where things had sold in 16, 17, and 18. And I'm talking about a real wide berth of property types, multifamily in one case, hotel in another case, office/industrial in a third case. And in each case, the loss was not epic. It was somewhere between 5% and 15% of the sales price from 5 or 6 years ago. But it does strike me as kind of underscoring your point. And that is when we got to 5% now, owners were in a panic mode, which said 5 can become 6, 6 can become 7. A $5 million loss on a $60 million sale now is a lot better than a $12 million loss down the road. So I think you're onto something there. I think that mentality could have shaken a lot of borrowers' confidence in where they were to the point where they sold these assets. Certainly the data shows that. And your secondary point, which is the fact that we're now back towards 4%, does the opposite come true? Do people say we're on the way to 3.5%? Let's double down. Let's hold on to these things longer. I guess only time will tell, but I don't think it's out of the question that people think they're now playing with a little bit of house money. Values have gone up just a little bit over the last 60 days. Why not roll the dice and see if that Fed cut comes in February or March, money gets cheaper and values continue to improve? I think your thesis is solid.
Yeah, it's really interesting. I was at an event down in Miami yesterday, and there was an economist there talking, and it was interesting to hear his perspective. He was saying that if you look at the markets, they're pricing in significant rate cuts in 24. He doesn't see it that way. I mean, he says going into an election year, the Fed doesn't like to be used as a pawn. For them to get to the pricing level on the rates that the market expectations are, they'd have to have like successive 25 basis point cuts leading into the election. And he just doesn't see that happening. So he was of the position of like higher for longer. But he brought up an interesting point of saying, if you look at the QE that was instituted during COVID and post-COVID and all the stimulus that was pumped into the market, QE adjusted interest rates were actually less than zero. And with the Fed's crazy action now, the QE adjusted interest rates are probably around 3%, not at 5, 6, 7 or whatever, the market is saying it is. And so, his thought was, the reason we haven't seen a recession and we've seen a little bit more of a soft landing relative to what expectations might have been was, for the first time in a while, we've seen the balance sheet explode at the federal level, and the QE adjusted rates, even though the Fed went up 500 basis points, haven't been fully felt through the system. So I thought that was kind of an interesting take as well, not something that we've necessarily delved into or talked about, but I think as you look at it, the markets, and we've talked about it, origination, I think we're going to have a little bit of discussion on that here in a little while. Compared to 08, 09, 10, 11, there's still been a lot of transaction activity relative, even though it's a downturn. I think CMBS issuance this year is on pace for about 40 billion, 42 billion. Last year was around 80 billion. So it's significantly reduced, but it's not anywhere close to zero. So I just thought maybe you had some thoughts on that as well. I know we're kind of getting a little bit out of the macro today, but a couple of hot button items that I got kind of jazzed about when I heard about them yesterday.
Well, there's a lot of distortions in the market right now. It's very hard for a guy like me to get my arms around. When you talk about $33 trillion in debt, $2 trillion a year in annual deficits, the demands of the Treasury to sell new bonds to finance that debt, where does that demand come from? What does that do to interest rates? You're getting to the very edge of my gray matter at that point, right? And it may be at the edge of a lot of people's gray matter because we're in areas that are really unprecedented when it comes to the amount of debt we have and so forth. And then when you throw in the other issue we talked about 6 months ago with Danielle Booth, is at the same time, the Fed has been trying to reduce its balance sheet by reversing the amount of treasuries that they hold, the amount of mortgage-backed securities that they hold, which people believed at the time 6 months ago that, the selling off of those positions at whatever it was, $90 billion a month or a quarter or whatever the number was going to be even more restrictive, right? That was going to have the impact of even additional rate hikes. And now nobody really talks about that. I wish I had been there with for the presentation in Miami, because it sounds like I would have learned quite a bit, that there's a lot of moving pieces. And when you compare the nominal rate or the nominal yield you see on the 10-year today versus really what it should be when you consider all these distortions, I think it's a little bit of, licking your thumb and sticking it in the air.
Yeah, it was definitely, there were moments where I couldn't write down my notes fast enough because it's above what I've studied. But an interesting perspective that just some of the soft landing is just outside of the control of the parties that are actually participating. So like the Fed, Powell's going to get credit for this like aggressive stance and posturing, but the reality might be that with all the QE and all these other external factors, he's really just kind of bringing it in line. So again, I don't, to your point, I'm not an expert in that, but just something interesting. We did have a couple of macro topics I'll just kind of run through quickly. Private payrolls were announced. They increased to 103,000 in November. which was below expectations. That's the ADP number. Something that was kind of interesting from the JOLTS report, job openings were 8.73 million for the month, which was a decline of just over 600,000, about 617,000, which equates to about 6.6%, which was the lowest total since March of 21, and brought the ratio of openings to available workers down to 1.3 to 1. So I thought that was somewhat interesting. And I think something, is timely given that the large banks were testifying today in open hearings. Wells Fargo announced that they're going to have another large set of layoffs. And I think the headline from this discussion was that their CEO said that they're going to have about 750 million in employee severance cost in Q4. While the bank CEOs, when testifying today, I think we're painting a fairly rosy picture, all things considered. There's definitely still some headwinds that they're going to be dealing with.
Yeah, I mean, the last thought on interest rates from my perspective is, and this is a little bit of a pivot, is it's a tale of two different markets right now from the borrower's perspective. If you are a long-term 5-year or 10-year guy, buy and hold, you're just trying to play off your balloon payment, you're trying to replace maturing debt, this has been a good week for you because rates have fallen again. And that fall in rates is tied to those things that you pointed to. That higher JOLTS number said, the jobs market isn't as overheated as we thought it was. The ADP number today, more of the same, right? The labor force, the labor market is getting a little bit more slack. The fact that firms are laying off, kind of more of the same. And that contributed to the lower rates, and that was to the good for people that are looking for long-term fixed rate debt. The people that are not out of the woods yet are the guys that are holding that floating rate debt, because that is so tied to SOFR, which is still at 5.4% or whatever it was today, and the Fed funds rate. And those rates there, the higher debt service will be in place regardless of where the 10-year Treasury goes until such point in time as we know that the Fed is going to start cutting rates. And so whether it's their carrying costs up to maturity on their debt service, which we know has gone from like 4% to 10% for some borrowers, or if it's the fact that they have the need to buy an interest rate cap to immunize themselves in order to get a loan extension, whatever the case may be, there's been no relief for them yet. And that relief won't come until we start seeing the Fed reducing short-term interest rates.
So another story we saw this week was actually from our sister company, CRE Direct, and they reported on the sharp increase in mortgage REITs originations in the third quarter, but we're still seeing anemic volume.
Yeah, so the major mortgage REITs definitely continue to see their loans getting repaid in the third quarter. But to your point, the origination or lending activity side, while it was up from the second quarter, really was still muted. So just to give some perspective here, we're looking at a set of 14 companies that were tracked. They reported receiving a collective 3.8 billion of loan repayments during the latest quarter, which was great, but they only originated 1.15 billion of loans. Really results in about a 4% reduction in the company's collective loan portfolios to about 89 billion. If you look at the origination side through September, they had only originated about $3.07 billion worth of loans. And while that's a big number, if you look at what they'd done in the previous year, they originated 30.7 billion. And in 2021, they originated 49.83 billion. So we're talking about 3 billion in issuance for this year as compared to 30 billion last year, 49 and some change the year prior. So a significant reduction in activity there. But at least for them, they're still receiving payments on the loans that they have, which is good news. And then I wanted to highlight, we had a listener from London that had written into us a couple of weeks ago, and Haley had mentioned on the podcast that we would circle back to the stories they had sent over. So we wanted to give a little bit of airtime today to Mike M. from London, who had sent us some information on some positive data in the European CMBS market. So Blackstone has reopened the European CMBS market in August. Citi and Standard Chartered pre-placed the last mile logistics deal backed by logistics properties around the UK. Seniors came in at 235 bips, double A's at 350, and the single A's at 450. And then in October, Deutsche Bank and Bank of America priced a couple of deals, which were the first publicly offered conventional European CMBS in well over a year. So I think this fits with the narrative that Manus talked about last week, where we started seeing more origination activity across the US-based CMBS markets. It's nice to see a couple of stories coming out of the European CMBS market coming online here over the last couple of months as well.
And I should put out a shameless plug, which I'm very good at and I do periodically. I've mentioned this several times over the last 2 or 3 months, but we have launched a new daily rundown email that comes out at 7:30 every morning. It's meant to go with the TreppWire podcast. So when I was talking before about property sales done at modest discounts to 2016 and 2017, a lot of this stuff specifically is covered in that daily email. All you have to do is email Haley or podcast@trepp.com to be added to that list. The response has been quite favorable so far. We're putting out 7 to 10 stories a day, which is about probably twice as many as we would get to in a single podcast, and yet we're doing that every day. We're getting contributions from a lot of different people here at Trepp, and we hope you enjoy it. That we hope you enjoy it as much as you enjoy the podcast. We certainly enjoy writing it as much as we do recording the podcast. So reach out to Podcast or Haley, and we'll get you on that list.
Yep, and you get to see and read some of our humor or dad jokes in written form rather than just audio form.
I've already written up tomorrow's. I made a remark about Taylor Swift being the most important person in 2023 for the commercial real estate market. When you consider what she has done for hotels in major U.S. cities where demand had been struggling, she was selling out hotels for 4 or 5 days at ridiculous RevPAR numbers. Then she went on to release a movie that grossed about $300 million, which was a big shot in the arm to the movie theater business. And all this came up because today she was named Person of the Year by Time Magazine. And we'll know that her tentacles have no end to their reach if we start seeing the return of the street side newsstand in New York City, right? 20 years ago, everybody would buy their Newsweek or their Sports Illustrated or their New York Post from the street side newsstand. Now nobody ever sells anything on the streets. There are no more Sports Illustrated. There's no more Mad Magazine. We'll see if she can single-handedly return the in-your-hand magazine to something that people traffic in going forward. So to be determined.
I wouldn't put it past her, though. If the Swifties decide that they want to see that make a comeback, I think they could make a comeback.
It happen. Yep. So street stands, and we talked about vendors on the street last week. Let's dive into our retail segment since we're kind of aligned there.
Okay, retail. As I was mentioning before, some really nice green shoots this week. The biggest one for me was the fact that a mall in San Francisco has been refinanced, and that was very exciting to see. The story here is there's a $164 million CMBS loan that was split across 2 2013 CMBS deals. The property is known as the Stonestown Galleria in San Francisco. In October, that was the largest conduit loan to miss its maturity date. The market, of course, in San Francisco, kind of weak. We saw Westfield close its mall down, throwing the keys on that property. Quality of life issues have been plaguing California. This is in a more upscale neighborhood, much more residential. But even with that as a backdrop, you never know. They missed the maturity date, and we weren't sure if this was going to go deed in lieu or an extension. But sure enough, the Real Deal reported this week that Brookfield lined up a $190 million loan to take out that 2013 note. Brookfield has been the owner of other properties out west that they've thrown back the keys on. In this case, they lined up new financing, and that new financing will allow them to take about $13 million in cash proceeds out of the property. The new CMBS loan will be put into a single asset securitization, we believe, and it will pay off, as I said, $164 million loan. The new loan does not come without a sizable cost to Brookfield. The retiring loan had an interest rate of 4.39% on the existing debt. The new rate, 7.91%. So about 3.5 percentage points of higher debt service costs for Brookfield. yet in a very positive sign. They lean in and get that extension.
Is this what you call, don't call it a comeback time? I mean, like, I think that's a good story to start the day off. So hopefully we'll have some more green shoots as we talk through the rest of the retail and office sectors, Manis.
So Lonnie, you asked for good. I'll give you more good. This one came out just as we were wrapping up last week's podcast. We put it in Friday morning's rundown email. Some of you may have seen it there. This is news that Tanger Outlets has acquired a Huntsville, Alabama shopping mall for $193 million. The interesting thing about this, and this is known as the Bridge Street Town Center, this is the first time Tanger has gone out of its lane, not buying an outlet center, is buying a real mall in this case. So that's an interesting twist to the story. The biggest thing for me is the price tag. Anytime you get into that 9-digit number, or in this case, almost multiple 9 digits, 193 million, it's a vote of confidence for the retail space. And it's good to see that sale go through.
It's interesting, as you mentioned, this is a little bit of a deviation from what they typically, the space they play in. I mean, I would assume very similar from an operations perspective, but not being an outlet center, I wonder if they're going to continue to operate it as a traditional mall, or if there's plans to maybe do something more aligned with their general business plan.
Yeah, it's of a piece. We mentioned maybe 2 or 3 weeks ago in Palm Desert, there was that Westfield Mall that sold for $125 million. We're seeing more and more of this take place where, and I think it goes hand in hand with what Carmen Spinoso told us last month when he came on for his interview, that people have come around to the notion that this retail apocalypse is not going to be as bad as they thought. People still want to go to the malls. Retailers still need a brick and mortar presence. Leases are getting done. In his case, he had several stories in malls, which I would call, not class A locations, where he was able to increase occupancy, push for higher rents, and help stem the tide for assets that we thought might be on their way towards CMBS purgatory. And it's great to see. I'll add one last point on retail before we move on to other property types. I've repeated it so many times, I feel bad for our audience because they've heard me say it so often. But if you haven't closed a store during COVID, if you haven't filed for bankruptcy, if you haven't gone Chapter 11, if you haven't thrown in the towel on certain locations by now, having lived through 2.5 years of COVID, a wave of bankruptcies from 17 to 20, and higher interest rates, chances are you're in this for the long haul, and you're going to stick with this property or this particular location. And let's hope so.
We also wrote about a retail sale that we saw involving an Aldi this week.
Yeah, so Aldi, for those that don't know, is kind of a discount grocery store. They've really been very aggressive in their growth trajectory over the last several years. And this center, which Aldi is an anchor tenant at, is about 102,000 square feet. It's the Dorneyville Shopping Center in Allentown, Pennsylvania. Sold for $17.8 million, which equates to about $175 a square foot. This comes from WFMZ TV. Aldi is the anchor, as I mentioned, and the center is about 86% occupied. The seller on this transaction was Josie Hotel Group, and the buyer was LS Property Investments. IPA, which is a division of Marcus & Millichap, handled the sale and procured the buyer. So another nice retail, grocery anchored shopping center sale at $175 a square foot in Pennsylvania.
I think we have even more retail stories, but let's jump over to our office segment and talk about some of the big headlines from this week.
Yes, as I was saying, there's a lot of positive momentum this week. One of the guys that really does a nice job covering this stuff is a guy named Steve Cuozzo of the New York Post. The New York Post, famous for a terrific sports section, its tabloid covers, which are usually hysterical, which cover current events and so forth, and are good for a chuckle or two, at least twice a week. But they also have really good commercial real estate coverage on new leases and property sales and so forth. And he had several this week that will run through, the New York market, not as bad as San Francisco, but certainly not a place where we think that, people are popping corks. So let's go through what we've seen this week and a lot of these stories he broke. The first one is at 280 Park Avenue. This is by Central Station. The New York Post reported that PJT Partners has not only extended its lease of 140,000 square feet, it has also converted an 80,000 square foot sublease into another 130,000 square foot direct lease. So the firm is now going from 220,000 square feet, of which some was sublease space, to 270,000 square feet. The firm will now have almost 25% of that 1.2 million square foot office. That office has seen a lot of coming and going over the last couple of years, and that's a good sign to see. That Grand Central Corridor, a lot going on around there, not all of it good, as firms have been looking to downsize. At one point, it was thought that Citadel might take 400,000 square feet at 280 Park. That deal fell through. So the fact that PJT Partners has extended there and expanded as well is really good news. At 230 Park Avenue, this comes from Commercial Observer. Scott and Scott has, and their law firm, has expanded and relocated. The firm has signed a 15-year lease for the 24th floor at that building. The new space is about 21,000 square feet. The property is also known as the Helmsley Building. Why might that ring a bell? Last month, we noted that the $670 million 230 Park Avenue loan had been sent to special servicing. That loan backs a 2021 single asset deal. The $20,000 new lease is very small. The whole property is 1.4 million, but when you're in special servicing, any lease is a good lease. The New York Post also reported that Stone Peak Partners signed a 15-year lease for almost 80,000 square feet at 245 Park Avenue. That same article by the Post said that BDT and MSD Partners signed on for about 70,000 square feet at 550 Madison Avenue. So 4 decent-sized leases in New York Midtown. That is great news for a market that hasn't seen a lot of big leases in 2023. So ending the year on a high note.
Yeah, it is good to see. And a couple of them on Park Ave, I think you had mentioned this before, Manus, but the location, proximity to Grand Central Station, some of the other subway outlets as well seem to make that a desired destination for office leasing in the moment. So hopefully for them, they can continue that momentum. It's great to have at least 4 or 5 nice, sizable lease stories in the city for us to talk about this week.
We also had a trading alert also in New York. This is also New York and Midtown. I'm not sure I'm going to be able to do justice to this story. This might be more in need of a book rather than a podcast to really go through it, but I will do my best to talk about this. This is a very intricate story, but it is a positive one. There is a property, 625 Madison Avenue, that sold this week for about $1,100 a square foot. The property had been bifurcated several years ago. The office itself was owned by SL Green. They lost a major tenant years ago. I think it was Ralph Lauren, which put this property in great distress. The property was also on the hook for a ground lease payment of about $5 million a year to a ground lease owner, which was Ashkenazi. Ashkenazi looked at the 625 Madison Avenue property, made the argument that the property itself would be better served as high-end residential. It made the case to an arbitrator that the ground lease should quadruple or quintuple in the dollar amount being paid when it reset. That moved the number from $4 or $5 million up to $20 million, which SL Green was not able to service given the fact that their property was largely vacant at that point. SL Green turned the tables on Ashkenazi, buying mezzanine debt on the ground lease. And if you stay with me on this, think about this. SL Green owed money to Ashkenazi. Ashkenazi wasn't getting that money from SL Green, so Ashkenazi could not pay the mezzanine debt on the ground lease, which, wait for it, SL Green bought on the sly. Now, SL Green is the master of Ashkenazi. They foreclose on the ground lease, take over the ground lease, and now sell the entire package, ground lease, building, whole kit and caboodle, to related companies, I believe. for $633 million. So a situation where SL Green is about to lose a major investment on Madison Avenue. They turn the tables, they flip the script, and they end up selling off this asset for north of $600 million, $1,100 a square foot. Really interesting story here. And what makes it interesting for CMBS investors is that the ground lease debt was in CMBS. It backed about $190 million in CMBS debt, was backed by the ground lease. For a long time, we didn't know what was going to happen to the ground lease. Was it going to be money good? Was it going to be extended? Was it going to be a default situation? Now this is expected to pay off in full any day now. So for those that are into intrigue and where fact is more interesting than fiction, The Real Deal has done a really nice job following this story for several months. And if you need their article, if you want to find it, let us know and we'll share it with you.
Yeah, man, I don't know that that's a book. I think that's a script for an action movie. That's pretty cool stuff. SL Green, they didn't sit back and be reactive. They took a proactive approach and said, we're going to double down and make this work for us. And it looks like they were able to execute pretty flawlessly. I mean, it's pretty remarkable to see that actually take place in the market.
Yeah, we got like shadowy figures and smoke-filled rooms, and we gotta find a way to get you in there, Lonnie. Like, get you as a bit character in this, covering the story. We got to figure out who would play you in the movie. We did have Dan McNamara on years ago. He is of the retail Big Short, really a guy who's been around a long time, made a lot of money shorting CMBX retail back in 2020. Real good guy. And we asked him who would play him in the movie, and he deferred to his cohort at the time. And she said, I think she said Matt Damon, I think, would play Dan McNamara. I'll have to go back to the tape and see that one. A couple negative stories that we had this week. I'll run through those very quickly. Back to SL Green, even though that they were able to finagle their way out of 625 Madison and sign some nice leases at 280 Park, they did have an earnings announcement this week and a CEO call. The real negative out of that is the CEO said a lot more pain to come in the office market, and we may not see a recovery for 4 years. So, Lonnie, you may have to come up with a new acronym or a new rhyme. Instead of survive till 25 for office, it may be something until 27 or 28, if you're to believe the SL Green gent. And then lastly, Alex Halverson out in Washington State. He writes for the Puget Sound Business Journal. He did an itemization of just how much damage the Microsoft retrenchment in the Bellevue and I-90 corridors will do to that market. It's a good read. If you need that too, we'll send you the link for that. He notes that Microsoft, which we know is giving up between 2 and 3 million square feet in the Bellevue, Seattle office market, had 9,400 employees as recently as 2021 when they closed their office in Bellevue in 2025, which they'll be giving back. They're relinquishing that space. Their headcount could fall to as low as 1,800 in that market. So a reduction of 75% of their headcount. And that's, we know the multiplier effect. If people cut office jobs, it's not just the office landlord that suffers, it's everybody in that ecosystem, and not a positive sign there for the Bellevue market.
Yeah, especially with that significant of a headcount reduction. So just to give you a little fun here, our friend Jeff Feldman put out a thing on Twitter in reference to your stay alive till 25. This was his running list for the next few years, Manish. You can tell me what you think about this. So he says, stay alive till 25, stay in the mix till 26, the bread will not leaven till 27, close the gate till 28, don't opine till 29, don't get dirty till 30.
Well, I like them all. I thought that was very, very clever. At my age, my thing is very similar. It's stay alive till 24, stay alive till 25, stay alive till 26. That's kind of my thing. So the longer I can keep the game going, the happier I will be. Although I'll probably drive my wife even crazier if I ever start puttering around like guys my age do. So while we're talking about the negative, we're talking about Microsoft and we're talking about SL Green, and it's going to take 4 years to recover. We do know that, right? We do know that there's more distress coming. And it just reminds me of something I read recently from the Henley Group. Tammy and David at the Henley Group are workout specialists. They work on behalf of property owners, very active during COVID in helping owners get forbearances. Since then, they've done a couple of big deals, a big one near Kansas City with a lease extension on a big complex there that was sitting on very low occupancy. Real experts in the space. They've put out a piece which is the ins and outs of how to give back keys if you're going to go deed in lieu on a property, what to do to make this as cost-free as possible, how to eliminate your future obligations, how to eliminate your future reputational risk, how to cross the T's and dot the I's. It's worth picking up. We did mention last week we want to get them on board to give us a sense of what's happening in the office market right now. But it's a piece worth picking up. If you're interested in that, let us know and we'll make sure you get a copy of that.
And we had a broker start your engine story this week.
Yeah, so this comes from The Real Deal. 2 Playa Vista offices hit the market. These are, offered for sale. The sales, assuming that they're actually able to take place, will hopefully help turn around market value transparency when transactions have been few and far between. The 2 properties total about 180,000 square feet, and they sit at 5340 Alla Road and 12901 West Jefferson Boulevard in Playa Vista. For context on these 2 properties, LaSalle Investment Management had acquired 5340 at $95 million, and they had acquired 12901 West Jefferson for $45 million. Both of those assets were previously purchased from Canyon Partners back in 2017. So it'll be interesting to see now that these are online, what they're able to fetch in the market, and if there's any type of appreciation or write down on these assets based on their transaction price in 2017.
I think these will be really, really important benchmarks to see. In San Francisco and in other markets, we've started to see things clear. We know where the bottom is at this point for these markets. I don't think we know anything close to where the bottom is in Los Angeles yet. We've got some interest in new BOVs, broker opinion of value, new appraisals on some distressed assets, but that does not in any way replace a bona fide sales transaction. And we haven't seen many of those in the Los Angeles office market. And I think where these come in will go a long way to both providing some transparency, assume that they do trade to where this market is right now, but also helping that market perhaps unlock and letting some other transactions take place. We'll see. I'll be very eager to watch that one and see where that deal gets done, or deals, as the case may be.
So lastly, we'll talk about some stories that we saw this week for apartments specifically. So 2 analysis out of Newmark came out looking at apartment property sales transactions and apartment renting.
Yeah, so there's some really interesting takeaways from these 2 stories. The first one looked at apartment property sales transactions. The headline here was that sales transactions took a 61.7% nosedive in Q3. Only 30.1 billion of apartment properties changed hands during the 3rd quarter, which was a 61, as I mentioned, percent decrease from the previous year, but up slightly from the 2nd quarter when only 28.2 billion traded hands. So I think this kind of speaks to the narrative that we talked about on the intro, Manus, of significantly muted transaction activity, both on the origination side and on the acquisition side, but still not zero. I mean, if you're talking about a $30 billion quarter on the heels of a $28 billion quarter, not terrible. If you look at this through September, so January through September, there's been about $90 billion worth of multifamily transactions that have taken place. So on that 9-month time period, you're about 47% below what it was in the previous year. So again, right in line with what we had mentioned earlier on the CMBS issuance, for about 50% year over year in terms of reduction. And then the other story, and I'll let you jump in on either of these, Manus, this one was really interesting. They did an analysis and looked at the cost of renting an apartment relative to the cost of purchasing a home or making a mortgage payment. And the takeaway here was that apartment renting was just about $1,000 a month cheaper than home ownership in the 3rd quarter. So they came out exactly at $994 a month cheaper on the rent side. And the data here was that the average monthly rent When you looked at apartments nationally, it was around $1,825 in the third quarter, which increased less than 1%. The previous quarter was around $1,800 per month. But if you looked at the median home mortgage payment, they were up almost 10% in the quarter to a total of $2,818. It had been $2,570 in the previous quarter. So at this point, renting was about 30% cheaper than owning a home. The interesting takeaway for me was that delta between rental cost and mortgage payment hadn't been more than $500 per month since 2010. And here we are at almost 2x that at about $1,000 a month. So I don't know what your thoughts are on that.
I think it's a little bit staggering, a little bit for me, that the combination of the end of COVID, meaning the demand for people to be away from other people, the higher interest rate costs, right? A doubling or more of your 30-year fixed rate mortgage has not done anything to reduce prices on the residential side. And when you throw in what you just mentioned, which is it's $1,000 a month cheaper to rent than to own a home, you would think with all of these factors that we would have seen a meaningful cooling off of the price appreciation that we saw from 2020 to 2023 for housing. And, I know that people point all the time to the fact that we have a real shortage of housing, single family homes in this country, and that's going to support prices for a long time. I get that, but when you're talking $1,000 a month where people are just starting with family formation, buying their homes in good faith, I couldn't tell my kids to go out and buy a house right now where rates are they are, where prices are where they are, knowing that you can get really, really nice apartments for a fraction of the cost of home ownership. And that doesn't even begin to factor in, the things that you don't even do, Lonnie. Like, I've seen your lawn, man. That thing looks like a fescue. You got that 4-foot high grass and stuff like that. Cut that lawn, man.
Crabgrass?
Shell out the, the $25 a week. Get the kid down the street to mow that thing. At home ownership, that's only part of it is the taxes and the home and stuff like that. But part of it is, the thing has to be painted every 10 years. The thing needs a new roof. You need a new boiler. That doesn't come with a rental situation. I'm not sure what's in the numbers that you were quoting before, but I always found that owning a house was about 15% more per year in cost than you ever thought it would be when you bought it in the first place, whatever that meant. I'm just a little bit stunned that this hasn't had more of an impact and this hasn't shown up in the Case-Shiller numbers to any significant degree, but that happens, right? Sometimes you expect one thing, whether it's student housing or non-essential shopping malls, and they just surprise you in a different direction.
Yeah, I think this is just a clear indication, and we talked about this on previous episodes, of how having prolonged really low interest rates where a lot of homeowners were able to lock in 3% mortgages has completely decimated the supply. So even though interest rates are crazy high, it hasn't negatively impacted pricing. But at some point, that's going to have to reverse, and you're going to start seeing prices come down. So I did read a couple of articles, and I know we're wrapping up this episode, but a lot of these large hedge funds and others that had bought thousands of houses across the U.S. to rent them out, it looks like they're maybe starting to offload some of those. So maybe that will increase supply, at least on the sales side, and hopefully bring prices down to where there's not such a huge dispersion between, renting cost and home ownership.
Let's go to our shout outs for this week. So we had an inbound from Mendy S, who is a weekly listener and big fan of the podcast. This is a special one for Andrew H. So we actually received a shout out from a friend of yours. We wanted to thank you for being a loyal listener and introducing our podcast to others in the industry. Chris D is a loyal podcast listener and also a Trepp client, and he reached out to us because he's in town for the ICSC conference here this week. So we're actually going to be meeting with him in our office tomorrow. So we look forward to that. I wanted to call out our own Will Moisen, who you can now find on Twitter. He had a good idea for our listeners who are always searching for some positive news. So he said, why don't we ask listeners who are finding green shoot stories or see some positive news to tweet at us and use the hashtag TreppGreenShoots. So if any of you guys have any stories that come to mind right now, tag us at TreppWire and use the hashtag, and we'll see if we can get that trending, Will. Then we had a bunch of good feedback from our episode with Shlomo Chop. So we wanted to shout out Sol R, Justin L, Miller C, and Blake K, who all commented some positive thoughts for us. And then lastly, before we close today, I wanted to plug our appearance and our attendance at the annual CRE conference that's coming up in a month. I know it's still a month away, but I guess I'm just dreaming of warmer weather in this cold New York City that we're in today. So the Trepp team will be down in Miami at the conference. This is CRE Finance Council's annual conference that they host every year, and we're always there. We will have a meeting room there. I think, Lonnie, you're on a panel there too, right? And we'll be representing from the podcast side of things, and all of our account managers and everyone that you work with all year long will be there. So if you want to email us to set up a meeting or coffee or a drink, come by and send us an email and we'll be able to do that.
Looking forward to it. Love that conference. Get to see a lot of old friends. The weather is a welcome difference from, like you said, that Northeast weather, which, January, February can be quite nasty, really enjoyable. And if we keep up this positive momentum we're seeing with lower interest rates and modestly improved leasing and property sales, I think maybe we have something to look forward to in terms of the tenor and the optimism at that conference.
Yeah, and as I mentioned earlier, Haley and Manis, I was at an event down in Miami this week, and not to rub it in, Haley, but the weather was like 85. It was pretty amazing. Although I will say I didn't leave the room. I was prepping for a presentation, and little shout out to the one hotel there on Collins. I got to stay there, and let me tell you, that was quite the treat. That hotel is really aptly named. It's probably the nicest hotel I stayed at. I think it's a Barry Sternlicht project. Really incredible. But looking forward to CRE as always. I'm going to be on the portfolio lenders survey, doing some discussion of some data we collect and presenting that at the conference. So looking forward to that as well.
Oh, and Shaq will be there. So we might have to get a 7XL podcast t-shirt and see if we can hand that over to him.
There we go. You got to get Shaq in that t-shirt. I love that idea. I know that we're in early December now. We're recording this on December 6th. Holiday party time, Christmas party time, Hanukkah party time. I know we have more recordings to do, but I do want to wish everybody happy Hanukkah, Merry Christmas, and a great holiday season for those that aren't going to check out our podcast until the new year. So happy holidays to everybody, but we'll see you again next week.
Ditto. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.